In June, a wave of panic over AI infrastructure spending wiped out nearly $2 trillion from the global markets in a single day. The sell-off was so aggressive that an entire national stock exchange had to completely halt trading to prevent a total collapse. Yet within 3 weeks, the S&P 500 had climbed back to record highs. Modern investors have been conditioned by years of bailouts and policy reversals to believe the system will always intervene. They see every dip as a temporary glitch rather than a warning. This refusal to acknowledge risk has created a massive blind spot in the West. While Wall Street remains focused on maintaining the safety net for a financial bubble, a tangible hardware threat is accelerating on the other side of the world. This is the Shanghai Stock Exchange, where a domestic memory chip maker called CXMT recently made its market debut. It was the most significant listing in mainland China in years. The response was immediate. The stock surged 535% in a single day, reaching a valuation of $460 billion. That is a market cap larger than Intel, AMD, and Qualcomm combined. Beijing prioritized the listing of a heavy industry hardware manufacturer over its traditional consumer internet or gaming giants. The market's aggressive reaction signals a clear alignment with the state's goal of industrial self-sufficiency. While Western markets focus on the abstract growth of AI software, China is securing the physical components those models require to function. They have utilized this IPO to fund a domestic monopoly on the hardware that will run the next decade of computing. The Buffett indicator, which compares total stock market value to the size of the U.S. economy, recently hit a record 238%. This is the highest level of market speculation in recorded history, surpassing even the height of the dot-com era. Much of this valuation is propped up by circular financing between 3 key players in the AI sector: NVIDIA, OpenAI, and Oracle. NVIDIA invests billions into OpenAI, which uses that capital to rent cloud capacity from Oracle. Oracle then takes that money and spends it buying more chips from NVIDIA. The same dollars cycle through the system, allowing each company to record the movement as brand new demand and revenue growth. This cycle is being fueled by unregulated private credit, often lent against software firms that AI is expected to replace. If the technology succeeds, it destroys the very companies the money was lent against. If it fails, the infrastructure loans go bad anyway. The American AI boom is increasingly reliant on this recycled capital and a debt structure that appears vulnerable regardless of the technology's performance. It is a financial mirage that ignores the reality of the global supply chain. China's strategy is the opposite. They took the $8.6 billion raised in the CXMT offering and immediately directed it toward building physical fabrication plants and securing top engineering talent from across the globe. They are targeting DRAM, the physical memory module seen here. These chips are the essential bottleneck for modern computing. Every AI model requires massive amounts of high-bandwidth memory to process data and run global servers. American export controls were intended to slow this progress by restricting access to advanced tools. However, these sanctions force China to aggressively develop its own equipment and internalize every step of the manufacturing process to ensure a self-reliant supply chain. CXMT is now a functional manufacturer, producing chips that compete with the global leaders in performance. Its success demonstrates a domestic semiconductor industry capable of scaling production despite external trade restrictions. The Western AI bubble faces a correction once lenders realize the technology isn't generating the immediate revenue needed to service the underlying debt. We saw this pattern in 2008, when the realization of hidden risks triggered a systemic collapse. China is positioned to capitalize on this downturn. As Western markets contract, CXMT can utilize its massive manufacturing capacity to flood the market with chips, driving global DRAM prices to historic lows. This volume-driven strategy forces legacy competitors like Samsung and Micron to match those losses or lose their market share. For these companies, a prolonged price war bleeds the profit margins required to maintain their own factories and fund next-generation research. By maintaining production through a financial crisis that cripples their competitors' margins, China can capture the global hardware market and gain the power to dictate future pricing. Consider a scenario where a geopolitical crisis prompts China to restrict memory chip exports. Because their competitors have been economically marginalized, there would be no immediate alternative to fill the gap. A sudden disruption in the DRAM supply would create immediate bottlenecks for any system relying on large-scale data processing. This includes the cloud infrastructure supporting Western intelligence networks, military logistics, and the production of all modern consumer electronics. The Shanghai IPO was the funding engine for a long-term strategy of physical dominance. In a conflict over the future of technology, control over the physical supply chain provides a level of leverage that financial speculation cannot replicate.